go ahead and start out part one, rights and obligations. Call buyers and put buyers, option buyers and sellers. Option buyers have rights, sellers have obligations. A buyer of a call option has the right to purchase stock at their strike price from trade inception until that contract expires. A put buyer is going to be the opposite. They've got the right to sell that stock at their strike price from trade inception until expiration. If you are buying a call, you are expressing a bullish sentiment on the market. You think the market is going to go up, or you think the particular stock price is going to go up. Puts, typically you're going to be the opposite. You think that stock is going to go down. Benefits of buying calls or puts is that you can take advantage of market movement, whether it be up or down, depending on call or put, with a smaller cash outlay or lower fees than if you were to just trade that stock outright. So if I'm buying 100 shares of stock at $50 a share, I'm investing $5,000. I can control that same amount of stock by buying a call option at significantly less and significantly lower prices and capital requirements. Potential risks when I buy a call is I can lose everything. Really, it's no different than buying stock. If I buy stock at $50 a share, I can lose theoretically $50 a share. Hopefully that's not going to happen, and it certainly doesn't happen very often, and it certainly likely isn't going to happen overnight. Different from options. Options are moving quickly and significantly throughout the day. If I'm buying a put, I'm looking to take advantage of falling share prices and doing so cheaper than selling stock short. My account may not be approved for short stock selling, so buying a put might be a way to accomplish the same thing without those extra necessary approvals. But the flip side, and things that we're here to talk about today, is selling options. So if I'm a buyer and I've got the right to purchase stock, then you, sir, as the seller, are going to be obligated to sell that stock to me should I decide to exercise my rights as the option buyer, as that call option buyer. If I'm selling a put, I am obligated to buy those shares that are put to me if I get assigned. Market outlook, if I'm selling calls, I'm bearish. I think the market's going to go down. I think the stock is going to go down, typically, right? And that's if I'm simply selling the call by itself. If I'm simply selling the put by itself, I'm expressing a bullish sentiment. I think the market is going to go up. But these are ways that I can capitalize on those market sentiments that I have and get paid to do so. If I'm buying an option, I need something to happen with the stock, with the market, with implied volatility, what have you. I need that stock price to move some way, because if it doesn't, there's a concept called time decay that is going to erode the value of my contract each and every day. So I need something to happen positively to impact my position to offset that time decay. That's if I'm an option buyer. If I'm an option seller, I want just the opposite. I want nothing to happen, or I want things to happen the way that I want them to. If I'm selling a call, I either want the market to go down, or I don't want the market to go anywhere. It can stay exactly where it is, depending on my strike price. But the point being is, option buyers need something to happen. Option sellers don't want anything to happen, typically. Potential risks of selling options can be infinite. When I buy stock, there's no limit to how high that stock price can go. When I'm selling the right to buy that stock, which is a confusing way to say when I'm accepting the obligation to sell that stock, if I'm selling a call option, I may be obligating myself to sell stock at $50 a share. If on expiration it's trading $500 a share now because something crazy happened, black swan event, or somebody tweeted something that was caused the market to do what it does, But the point being is, because there's no limit to how high that stock can go, there's no limit to my risk as a naked call seller. And we say naked as to mean uncovered. There's a strategy called a covered call, where we're selling a call option against our stock. The reason it's covered is because our obligation to deliver those shares is already fulfilled. We've already got those shares in place. If we didn't have those shares in place and we had to go out into the market to buy them, if I sold a $50 call, I'm obligated to sell that stock at 50. If the market is now 500, I am obligated to buy stock at $500 a share in order to sell to you at $50 a share. I am not going to want to do that very often, right? I'm not going to be a successful investor if I do that too often. But the potential risks of selling as selling a call, potential risks are infinite or unlimited. Potential risks of selling a put is going to be that strike price all the way down to zero. If I'm obligated as a put seller to buy stock upon assignment at $50 a share, and that stock drops down to, zero, I'm still obligated to pay $50 a share for a stock that's worthless. So my maximum risk as a put seller is going to be my strike price all the way down to zero. Now, it would be somewhat offset by the premium that I collect when selling options, but it still is a very significant and substantial risk. Let's look at a couple graphs. If we're selling a naked or uncovered call, hypothetically, we sell a $50 call at a $2 premium. We are bearish on our forecast. We think that the stock price is going to drop, or we're thinking that implied volatility might decrease. For those of you that aren't familiar, implied volatility is the market's expectation. This is the way that I explain it, and let me know if you think it's as understandable as I'm hoping it is. It's the market's expectation of future volatility of the stock as expressed by the value of the option or the price of the option. Now, implied volatility, or just volatility as it itself, you can look back on a chart and see where the stock was yesterday, where it was 3 weeks ago, where it was 6 months ago. You can, look back and actually see how that stock performed. But we have no idea how it's going to perform going forward. And that's where implied volatility comes in. It's the market's expression of future volatility for that stock as expressed for the price of the option. So, and that was kind of an aside, so I apologize for that. But the thing about implied volatility is if it increases, option prices increase, which is good if you're a buyer, bad if you're a seller. So if I'm selling a call, I either want that stock price to decrease or I want implied volatility to decrease so my option gets cheaper. If I sell something at $2, I'm going to be profitable if I have the ability to buy it back for $1, right? So I want that $2 price to go down any way that I can, whether it's because the stock price, stock prices came down, or implied volatility decreased and that reduced the value from $2 down to $1. So either of those scenarios work for me as a seller. Break-even point. This is a concept that I think is incredibly important when we're investing, whether we're buying or selling. This is the point that tells me where I begin making or losing money. When I'm buying a call option, my break-even point is going to be my strike price plus the premium that I paid. And think about it. If I'm buying a $50 call and I pay $2 for it, it gives me the right to buy stock at $50 a share. But I paid $2 for that right. So I'm really paying $52 for that stock, right? That kind of makes sense, yeah? Conversely, as a seller, if I'm obligating myself to sell those shares at $50, but I'm getting paid $2 to do so, I'm really selling that stock at $52. So that's my break-even point as a seller. It's going to be my strike price plus the premium that I collect is going to be the break-even. So anything below $52, if the stock price finishes at expiration in this example, below $52, I'm going to make some money. If it's above 52, I'm going to lose money. right? If it's below $50, that's where I'm going to have my maximum profit. It doesn't matter if the stock goes down to zero, because what's going to happen, I sell you the call, I sell you the $50 call, you pay me $2. Stock on expiration is trading $25. You're not going to want to exercise your call and buy the stock from me at $50 a share when it's trading $25 in the market. So this gentleman is just going to let his long call option expire, which means that my short call option is going to expire unassigned, and that $2 premium I keep. I retain 100% of that. All right, so when we're selling options, ideally we want them to expire without value and unassigned. Break-even point 52, so anything below 50, that's where we're going to get our maximum profit. If we... I just lost a slide there. There we go. So our maximum gain, $200. Our maximum risk, unlimited. Anytime we sell options, the most we can collect, the most we can profit is that which we received in premium. When we buy options, our maximum risk is that which we put into it. When we're selling options, our maximum profit is that which we collect. All right, does that make sense? Let's look at puts. Selling naked puts, a bullish strategy. Some people look at it as a way to buy stock at a discount. That's kind of a strategy called a cash secured put, but really the concept is the same. We may be bullish on the stock, and we're either looking to profit from increases in stock price, and we're not really profiting from the increase in the stock price, but what we're really doing is that price increase is reducing the value of our option. If the stock goes up from 50 to 60 and I'm selling that $50 put, I am obligating myself to buy stock at $50 a share upon assignment, right? But this gentleman here, bought that put from me, and he's got the right to sell me that stock at $50 a share, which he's certainly not going to want to do when it's trading 60 in the open market. So this gentleman's going to let his put expire without value, and he's not going to exercise it most likely, which means that on the flip side, my short put isn't going to be assigned. So it's not necessarily that I'm looking for an increase in the stock price to profit. What I'm looking for is that increase in the stock price to devalue my option enough to where really nobody wants it. Nobody wants to exercise or force me to buy the stock from them. And a decrease in implied volatility will do that as well. Anything that lowers those option prices, if I sell that put for $2, if decreasing implied volatility lowers that put price down to $1, then I'm going to go ahead and profit. So our maximum gain is going to be $200. Our maximum risk is going to be substantial. The reason, again, we say substantial, it's going to be our strike price all the way down to zero. If I sold that $50 put and stock goes down to 20, I am obligated to buy those shares at $50. Stock goes down to zero, I am obligated to buy those shares at $50. So that's why we say our risk when we sell naked puts is from our strike price all the way down to zero. And then again, that would be offset by whatever premium that we collect. Variations of selling calls and puts, and these are a little bit more popular strategies, more widely utilized. I don't believe that there are a lot of people that are out there trading, certainly not a lot of retail investors trading naked calls and puts. And again, we say naked because it's uncovered. A naked call, we don't have those shares to fulfill our obligation if we are forced to sell stock at our strike price. We have to go out in the market and buy that stock. So our obligation isn't collateralized, if you will. Puts, there's something called a cash secured put where if we're assigned on our put, we're forced to buy those shares. If we already have the cash in our account to do so, that's called a cash secured put because our obligation is already covered. We already have the financial means to cover that obligation. Now, one of the things about a a naked option versus a covered option is going to be margin treatment. And margin typically varies from firm to firm, so I won't get into it too much, but your brokerage firm, your trading firm, when you're selling options, is going to require margin to cover what they consider anticipated risk. If I'm selling a call, right, naked call, that stock can go to the moon. My brokerage firm is going to say, well, we don't have to protect you if it goes to the moon, but, maybe at least to the, stratosphere. Maybe if it goes up to the cloud layer. So we're going to want some money just to cover a portion of that risk should things go wrong. If our risk is already collateralized, either through having long stock on hand, and that would be a strategy called a covered call, or if it's collateralized because we already have the cash in the account, that's the cash secure put, our margin treatment is going to be more favorable for us as investors. So just real quick, a covered call is where we're selling a call option either at the same time that we're purchasing that stock, or we already have that stock in our account and we're selling a call against it. A cash secured put, we're selling a put and we're depositing the funds required to fulfill our obligation. Should we get assigned, we're depositing those funds in our account. So that's the setup of these two trades. The objective of both are generally income generating. Anytime we're selling options, we're looking to generate income. With a cash secured put, it's maybe a little bit different because we're looking to potentially a phrase you may have heard of called buy the dip. Stock is trading 100. We like it there, but we would love it at 95. So maybe we sell a 95 strike put. We deposit the cash to buy stock at 95 in our account. And if the market does get down to that point, we're going to go ahead and buy those shares. But in the meantime, we've also collected premium when we sold that option. So we're buying a stock at a discount, number one, and we're getting paid to do it on top of it. Market outlook, both of these are generally neutral to moderately bullish. Potential benefits, potential risks. Most of those risks lie within that stock position, whether it's the market going to zero or stock getting called away, what have you. But these are some of the more popular variations of selling options.